What if you could combine three powerful trading concepts into one strategy capable of producing sniper entries and massive risk-to-reward ratios? That's exactly what you're about to discover in this video. Before we dive in, let me show you what you will learn in this video. Liquidity sweep concepts and how they may reveal institutional footprints, how to identify high-quality supply and demand zones, how to use candlestick patterns to confirm reversals, how to combine these concepts into one powerful trading strategy, how to find sniper entries with exceptional risk-to-reward ratios, how to apply this strategy in both day trading and swing trading. This strategy can be applied to Forex, stocks, indices, commodities, and cryptocurrencies. Before we get started, if you enjoy our videos, make sure to like this video, subscribe to the channel, and hit the notification bell so you never miss a new upload. Now, let's dive in. The first concept behind this strategy is the liquidity sweep. There are three important types of liquidity sweeps that occur in the market and that you should understand. The first type is a liquidity sweep with a tail. This occurs at a support or resistance level and is characterized by a long wick. In the case of a liquidity sweep at resistance, the market forms a long upper wick. In the case of a liquidity sweep at support, the market forms a long lower wick. The second type is a liquidity sweep with one candle. The market reaches a key level, retraces back to it, breaks it with a single candlestick, and then another candle closes back below the level, as shown in this example. As a result, stop losses are triggered, and many retail traders become trapped. The third type is a liquidity sweep with multiple candles. In this case, the market reaches a level and reverses, forming, for example, a support level. Price then retraces back, breaks below the level with multiple candles, and eventually closes back above it. This is what we call a liquidity sweep with multiple candles. Now, let me show you an example of a liquidity sweep with a single candlestick. Take a look at this chart example. As you can see, the market hit this level and reversed, forming a support level. Now look at what happened next. The market broke below the support level, and breakout sellers thought it was time to sell the market. But look at what happened next. Another candlestick pattern formed and closed back above the support level. What happened here was a false breakout, designed to shake out sellers and trigger their stop-loss orders. Now look at what happened next. The market moved strongly to the upside. This strategy is often used by institutional traders, and in this video, we are going to combine it with other institutional concepts to identify some of the best trading setups in the market. Now, let me show you an example of a liquidity sweep formed by multiple candlesticks. Look at another chart example. The market moved up, hit this level, and reversed, forming a resistance level. Now look at what happened next. The market moved higher and broke above the resistance level. At this point, breakout buyers thought it was time to buy the market. However, look at what happened next. The market formed two candlesticks that closed back below the resistance level. This is another liquidity sweep that occurred to trap retail traders and trigger their stop losses. Now look at what happened next. As you can see, the market moved strongly to the downside. Now, take a look at another chart example of a liquidity sweep with a candlestick tail. As you can see, the market was trending upward. It reached this level and reversed, forming a resistance level. Now look at what happened next. The market returned to the resistance level, broke above it, and then closed back below it, forming a candlestick with a long upper wick. This wick represents the liquidity sweep. A liquidity sweep with a long tail is considered one of the strongest types of liquidity sweeps because the stop-loss hunt happens very quickly before the market reverses in the opposite direction. Now look at what happened next. As you can see, the market moved lower exactly as expected. If you open your charts and start looking for these setups, you will find many of them because this is one of the ways institutional traders trap retail traders before moving the market in the intended direction. Now, let's move on to another institutional strategy that we can use to track institutional footprints. Take a look at this example. Sometimes you will notice a very strong move to the upside that clearly stands out on the chart. Such an aggressive move often indicates institutional activity because retail traders alone cannot move the market this way. Once we identify this move, we draw a zone at the origin of the impulsive move. This area is called a demand zone. The reason behind this is that hedge funds and large institutions cannot execute all of their buy orders at once. Instead, they gradually accumulate their positions. As a result, when the market retraces back into this area, institutions often step in again and continue buying. This is why you frequently see the market retrace back into the zone and then rally strongly once again. This area is called a demand zone. If you can identify these zones and combine them with liquidity sweeps, you will be able to track institutional footprints and gain a better understanding of where institutions may enter the market. This allows you to trade alongside them instead of becoming victims of their tactics. The same principle applies to a supply zone. Sometimes, the market makes a very strong move to the downside that clearly stands out on the chart. This aggressive bearish move can also indicate institutional activity. We then draw a zone at the origin of the move, which is called a supply zone. When the market eventually retraces back into this area, institutional sellers may step in again, causing the market to move strongly lower once more. To be able to identify supply and demand zones, you first need to understand the four main supply and demand patterns. The first pattern is called the drop-based rally demand zone. In this pattern, the market moves down, pauses for a short period, and then rallies strongly to the upside. The second pattern is the rally-based rally demand zone. Here, the market moves up, pauses, and then continues moving strongly higher. The third pattern is the rally-based drop supply zone. In this case, the market moves up, pauses, and then reverses sharply to the downside. The last pattern is the drop-based drop supply zone. Here, the market moves down, pauses, and then continues moving strongly lower. These are the four most important supply and demand patterns that every trader should understand. Now take a look at this chart example. As you can see, the market formed a rally-based drop pattern. This is what we call a supply zone. Notice how the move to the downside is quick and strong. The candlesticks are large, and the previous support level has been broken. This is often considered a footprint of institutional selling. Now, we draw the supply zone and wait to see what happens next. As you can see, the market later moved higher and eventually returned to the supply zone. Once price entered the zone, a clear bearish engulfing pattern appeared. This pattern indicates that sellers have overwhelmed buyers and that the market is likely to move lower. Now look at what happened next. As you can see, the market moved down exactly as expected. The rally-based drop pattern is an institutional footprint that occurs frequently in the market, and when identified correctly, it can significantly improve your trading results. Now, take a look at another chart example. Here, we have a drop-based rally pattern, which forms a clear demand zone. As you can see, the market makes a strong move to the upside. The candlesticks are large, the move is quick and impulsive, and the previous resistance level is broken. After identifying the demand zone, we simply draw the zone and wait to see what happens next. Now look at what happened. As you can see, the market retraced back into the demand zone. Once price reached the zone, it was strongly rejected and moved higher once again. Supply and demand zones are considered the footprints of smart money, and when identified correctly, they can provide high-quality trading setups. Now, take a look at another chart example. Here, we have a clear rally-based rally pattern, which forms a demand zone. Let's draw the demand zone. As you can see, the bullish candles are strong, the move is quick and impulsive, and the previous resistance level is broken. This indicates a strong imbalance between buyers and sellers. Now look at what happened next. As you can see, once the market retraced back into the demand zone, price was rejected, and the market moved strongly higher once again. Now, take a look at another chart example. As you can see, we have a clear drop-based drop pattern. This forms a supply zone. Let's draw the supply zone and wait to see what happens next. Now look at what happened. As you can see, the market retraced back into the supply zone, retested it, and then moved lower, exactly as expected. Now, understanding supply and demand patterns alone is not enough. Once you identify a potential zone, there are several factors you need to evaluate to determine whether the zone is truly valid. Take a look at this chart example. As you can see, we have a clear drop-based drop supply zone. Now, let's analyze whether this zone meets the criteria of a high-quality setup. The first criterion is the strength of the move. One of the easiest ways to judge the quality of a zone is by looking at the size and momentum of the candles leaving the zone. When you see large, impulsive candles moving aggressively in one direction, it usually suggests strong institutional participation. On the other hand, if the candles are small, slow, and filled with long wicks, this often indicates weak momentum and market indecision. As you can see in this example, the bearish candles are large and aggressive, which suggests that strong sellers were involved in this move. The second criterion is the freshness of the zone. Generally speaking, the first retest of a supply or demand zone tends to provide the highest probability setup. Why? Because when price revisits a zone multiple times, many of the pending institutional orders may already have been filled, reducing the strength of the area. As you can see, this supply zone is still fresh because price has not returned to it before. This increases the probability that the zone may still contain unfilled institutional orders. The third criterion is the break of market structure. High-quality supply and demand zones are often created after price breaks an important level, such as a previous support or resistance level. A strong break of structure suggests that there has been a shift in order flow and that institutions may be taking control of the market. As you can see in this chart example, the market strongly breaks below the previous support level. This break of structure adds further confirmation that the supply zone is valid. The fourth criterion is the risk-to-reward ratio. No matter how good a setup looks, you should avoid taking trades that do not provide a favorable risk-to-reward ratio. As traders, we want our potential reward to be significantly greater than our risk. A good rule is to look for setups that offer at least a 1-to-2 risk-to-reward ratio. As you can see in this example, this setup provides a risk-to-reward ratio of more than 1-to-4, making it a very attractive trading opportunity. So, these are the main factors that you should consider when evaluating the quality of a supply zone. The exact same principles can also be applied when analyzing demand zones. Now that you understand how institutions use liquidity sweeps and how to identify them on the charts, and how supply and demand zones work, it is time to move on to the final element of our strategy, candlestick patterns. Now, let me ask you something. Do you know this man? His name is Munehisa Homma. He made a fortune trading the rice market centuries ago, equivalent to billions of dollars in today's money. He is widely regarded as the inventor of Japanese candlestick analysis and used candlestick patterns to understand market psychology and predict future price movements. In this video, we are going to use 5 of the most important candlestick patterns from his methodology as entry signals, combining them with supply and demand zones and liquidity sweeps. This way, you will have a trading setup based on 3 powerful elements. First, a supply or demand zone, which may reveal areas where institutions are buying or selling. Second, a liquidity sweep, which is often used to trap retail traders and collect liquidity. And finally, a candlestick pattern inspired by Munehisa Homma's work, giving us additional confirmation before entering the trade. When these 3 factors align together, they can provide extremely high probability sniper entries. The first candlestick pattern used by Munehisa Homma is the hammer candlestick. This pattern usually appears after a strong decline and signals that selling pressure may be coming to an end. The hammer is characterized by a small body near the top of the candle and a long lower wick. This long lower shadow tells us that sellers initially pushed the market lower, but buyers stepped in aggressively and rejected those lower prices, forcing the market to close back near its highs. In other words, the market is showing signs that bearish momentum is weakening and that buyers may be regaining control. Now, let's look at the opposite of the hammer candlestick, which is the shooting star candlestick. This pattern usually forms after a strong uptrend and signals that buyers may be losing control of the market. The shooting star is characterized by a small real body near the bottom of the candle and a long upper wick. This long upper shadow tells us that buyers initially pushed the market higher, but sellers stepped in aggressively and rejected those higher prices, forcing the market to close back near its lows. In other words, bullish momentum is weakening and selling pressure may be starting to build. Munehisa Homma understood that when the market rises too quickly and then strongly rejects higher prices, it can be an early warning sign that the uptrend is becoming exhausted. The Doji was one of the candlestick patterns that Munehisa Homma paid close attention to, not because it predicts the future direction of the market, but because it reveals indecision. A doji forms when the market opens and closes at nearly the same price, showing that neither buyers nor sellers were able to gain control. However, the meaning of a doji depends heavily on where it appears. When a doji forms in the middle of a strong trend, it often represents a temporary pause or consolidation before the market continues in the same direction. On the other hand, when a doji appears near an important support or resistance level, it can signal that the current trend is losing momentum and that a reversal may be approaching. Munehisa Homma understood that the doji itself does not tell us where the market will go next. Instead, it tells us to be patient and wait for confirmation. The candlestick that forms after the doji is what often reveals the market's true intentions. The next candlestick pattern that Munehisa Homma paid close attention to is the engulfing candlestick pattern. For Homma, this pattern represented a clear shift in market control. A bullish engulfing pattern forms after a decline, when a strong bullish candle completely engulfs the body of the previous bearish candle. This suggests that buyers have stepped in aggressively and may be taking control of the market. On the other hand, a bearish engulfing pattern forms after an uptrend, when a strong bearish candle completely covers the previous bullish candle. This indicates that sellers may have gained control and that the market could move lower. What made the engulfing pattern so important to Homma was not simply its appearance, but the psychology behind it. It shows that one side of the market has completely overpowered the other, signaling a potential shift in sentiment and direction. The next candlestick pattern that Munehisa Homma paid close attention to is the Harami pattern, which is known today as the inside bar. This pattern forms when a smaller candle is completely contained within the range of the previous larger candle. To Homma, the Harami represented a period of indecision and compression. The market temporarily slows down, volatility decreases, and both buyers and sellers hesitate before the next major move. However, the meaning of this pattern depends heavily on its location. After a strong bullish or bearish move, the Harami can signal that momentum is weakening and that a potential reversal may be approaching. On the other hand, when it forms during an established trend, it can simply represent a temporary pause before the market continues moving in the same direction. In other words, the Harami is not a prediction of direction. Instead, it tells us that the market is consolidating and that traders should wait for confirmation before making a decision. This is why the candle that forms after the Harami is often the one that reveals the market's true intentions. Now that you understand how institutions use liquidity sweeps, how to identify supply and demand zones, and how Munehisa Homma used candlestick patterns to read market psychology, it's time to combine everything together. Now, look at this chart example. This is the US dollar against the Swiss franc on the 15-minute chart. As you can see, the market initially formed a drop-based rally pattern, creating a potential demand zone. Let's first qualify this zone. Notice that the departure from the base is strong and impulsive, with large bullish candles. We can also see that the market broke above the previous resistance level, which further confirms the strength of this demand zone. Next, we draw the demand zone and evaluate the risk-to-reward ratio. As you can see, this setup offers at least a 1:5 risk-to-reward ratio, which makes it a high-quality trading opportunity. However, before entering the trade, we still need confirmation in the form of a liquidity sweep. Now, look at what happened next. The market retraced back into the demand zone, briefly broke below it, and then quickly closed back inside the zone. This is what we call a liquidity sweep, where the market triggers the stop losses of buyers and traps breakout sellers before reversing higher. At the same time, we can see the formation of a hammer candlestick pattern, which shows that buyers strongly rejected lower prices and may be regaining control of the market. At this point, all three elements are aligned: a qualified demand zone, a liquidity sweep, a bullish hammer candlestick pattern. This creates a high probability sniper entry. You can place your entry at the close of the hammer candlestick, your stop loss below its wick, and your target at the next major resistance level. As you can see here, we adjusted our profit target to the next major resistance level, which represents a potential selling area in the market. Now, look at what happened next. As you can see, the market moved higher and eventually reached the target as expected, providing us with a 1:11 risk-to-reward ratio. In this trade setup, we successfully combined supply and demand, liquidity sweeps, and candlestick patterns to identify a high-probability trading opportunity. Now, look at another chart example. This is the British pound against the Japanese yen on the 5-minute chart. As you can see, the market was trending upward, and here we have a drop-base rally demand zone pattern. We begin by drawing the zone. Now, let's qualify this demand zone. Notice that the candles leaving the base are large, the move is quick and impulsive, and the previous resistance level has been broken. These are all signs of a strong demand zone. Next, let's evaluate the risk-to-reward ratio. As you can see, the initial setup offers at least a 1:6 risk-to-reward ratio. Now, look at what happened next. The market retraced back into the demand zone, briefly broke below it, and then closed back above it. This created a clear liquidity sweep, along with a well-defined hammer candlestick pattern. At this point, we have all three elements aligned: a qualified demand zone, a liquidity sweep, a bullish hammer candlestick pattern. We can now consider taking the trade. The entry is placed at the close of the hammer, the stop loss goes below its wick, and the target is set at the next major resistance level. Now, look at what happened next. As you can see, the market moved higher and reached the target, providing us with a 1:3 risk-to-reward ratio. The final risk-to-reward ratio changed because we adjusted both the entry and the stop loss based on the hammer candlestick signal. This strategy is not limited to scalping or intraday trading. It can also be applied to swing trading. Now, take a look at this daily chart. This is the US dollar against the Canadian dollar on the daily chart. As you can see, the market formed a rally-based drop supply zone pattern. We can now draw our supply zone. Let's qualify the zone. Notice that the departure candles are large, the move is quick and impulsive, and the market broke below the previous support level. These characteristics indicate a strong supply zone. Next, let's evaluate the risk-to-reward ratio. As you can see, this setup initially offers at least a 1:6 risk-to-reward ratio, although we can later adjust our target depending on the new levels that develop in the market. Now, look at what happened next. The market retraced back into the supply zone, briefly broke above it, and then closed back below it, creating a clear liquidity sweep. At the same time, the market formed a shooting star candlestick pattern, indicating that buyers were rejected and that sellers may be regaining control of the market. At this point, we have all three elements aligned: a qualified supply zone, a liquidity sweep, a bearish shooting star candlestick pattern. We can now take the trade. The entry is placed at the close of the shooting star candle, the stop loss is positioned above its wick, and the target is set at the next major support level. Now, look at what happened next. As you can see, the market moved lower and eventually reached the target, providing us with an impressive 1:3 risk-to-reward ratio. This example clearly shows how combining supply and demand zones, liquidity sweeps, and candlestick patterns pioneered by Munehisa Homma can help traders identify high-probability trading opportunities. I hope you enjoyed this video and learned something valuable. If you did, make sure to like, subscribe, and turn on notifications. Thanks for watching, and I'll see you in the next video.